The most common question I get asked is how can I stop paying more tax than I have to? And it's a great question, and we're going to dig into some of those key features. Now, if you suspect you're overpaying in taxes and you feel frustrated and you feel like there isn't a good option, many of the people we talk to, they don't want to tinker with it for fear of making it worse. And I understand that. Taxes are complex, taxes are confusing. But here's what I found after 10 years of working with high income earners. In my view, doing nothing is one of the worst financial decisions that we could make. So in this video, I'm going to walk you through the 4 things or strategies that I see clients miss the most that could potentially create a better or more favorable tax environment for them. Now, why are we talking about this? Let's imagine you have a beautifully manicured yard. And that grass is lush, that grass is green. You're the envy of every neighbor that drives down the road. I know I wish my yard was that way. And what's happening right now is we have a leak in our sprinkler system, and that water is just slowly dripping out. And if we don't do anything, eventually that grass in that area, it's going to begin to turn brown. It's going to die. We might get a fungal infection, and our water bill is going to go through the roof. And it makes sense. To fix it, you got to rip up that yard. You got to dig out those pipes, and you got to replace it. It's a lot of work, and it's going to make a little bit of an ugly spot in your beautiful lawn for a little period of time. However, if we leave it alone, we all know this, leaks, they get worse and worse as time goes on. And that is exactly what's happening in so many people's tax world right now. You suspect you're paying more than you should, but digging it up feels like a lot of effort, and we don't all want to go through that without the certainty that it'll get better. But let's take a look at what we can do. So the first one is the gifting of appreciated assets. Now, we at 49 Financial say friends don't let friends give cash. I'm going to walk you through why we say that here in just a minute. A lot of the clients we work with, they're incredibly generous, and we love that. We want to support that heart and that endeavor. But one of the most common things we see is that they give cash. And what we can show clients mathematically is that there's actually a more effective and efficient way to give, and that's in the form of giving appreciated assets like stock or like real estate or like business equity. So why is that important? Because we get the same income tax write-off today as if we gave cash, but what we're doing at the same time is lowering our future tax burden on that appreciating asset. So that's the first one. It's not necessarily about where you give, it's how you give. Now let's look at the second one with where we save. So we're going to walk through Roth and traditional and the math that so many people refuse to walk through. Choosing between Roth and traditional can actually shape the next 20 years of your taxable time horizon. Now, the answer I hear from so many clients when I ask why they're saving to a traditional 401k is because my income will be lower in the future, so I'll pay less tax. And that logically makes a whole lot of sense. My question is, does it mean that we're going to pay less tax over your lifetime via what I call a lifetime tax bill? And as planners, our job is to model that out. We also want to take it one step further. If legacy is an important part of your situation, what's the impact to kids or grandkids 20, 30, or 40 years down the road? And unfortunately with this, there's no easy answer. The right answer is to do the work and do the math. But as planners, that's why we have jobs. Now, if you're curious on how these numbers may look for you or what could make the most sense for you, feel free to reach out to me via email or on my website. Both links are included below. Number 3, Roth conversions. Now, this is an incredibly hot and popular topic right now. And many of the people I talk to say, Patrick, it is just so dang confusing. And hand up, I'm not going to argue with you on that. It is complex, it is confusing, and we want to make sure we get it right. So many clients, they understand the theory where the value is. In fact, a lot of them understand that I'm moving money from an account that's going to be taxed as income to an account that I can take out tax-free. Now, all of that is true. We need to go one step further and discover, is it so we can take it out tax-free? Or is it so that we minimize the required minimum distribution burden that could be coming for you and your family? And again, this is just a simple math problem. And in my opinion, it's the difference between a money manager that tells you how much money to save and where to save it to in terms of this stock or that stock, and a planner who takes one step back and says, well, what's the 20 or 30-year impact of doing a Roth versus traditional, and how might that impact are conversions down the road. And the fourth one is what's known as the backdoor IRA. There's a couple different versions of this. There's your regular backdoor IRA, and there's what the industry calls the mega backdoor IRA. And as you would imagine, it's very similar to the regular backdoor, it's just done on a larger scale. But the reason clients ask, does this really move the needle, is because the government really restricts how much we're able to put into these accounts each year. And my answer is, very simply, it depends. Every client scenario is different, and we need to do the math of what a backdoor IRA would cost us today in terms of tax dollars, but potentially save us in the future when we get into distributions in tax-free dollars out of those Roth accounts. The beautiful thing about creating a tax plan is that it's customized to every client. We're not only looking at your peak earnings, we're also looking ahead into the future at distributions to ask the question of how can we lower our tax burden over time. And every client, that decision's up to them. They get to determine, is that juice worth the squeeze with the impact it's going to have on my family? Do we want to keep doing what we're doing today, or do we want to make some small tweaks and changes? And ultimately, every one of these topics we've talked about comes down to the same question. What does the math say, and is that value worth it to me and my family? Now, there's something you might not realize. Of these four we talked about, the real cost might not actually come down to you. It could come down to your kids. And of that, what I'm talking about is Roth conversions and the impact that has on the next generation from a legacy standpoint and an inheritance standpoint. In the next video, I show you the numbers. I run the numbers on Roth conversions and the impact it has on future generations. For this client, the impact of those kids was almost $4.7 million after tax. If you click here, I'll walk you through exactly how that math breaks down and why that could be a conversation worth having.